the gold standard for yield, a comprehensive guide to Schwab U.S. Dividend Equity ETF, SCHD. As of January 28, 2026, the Schwab U.S. Dividend Equity ETF, ticker SCHD, has solidified its reputation as the cult favorite of the dividend world. While 2025 was a year defined by high-flying artificial intelligence stocks, SCHD has remained the fortress for investors who prioritize tangible cash flow and financial stability over speculative growth. For an investor today, SCHD is the ultimate slow and steady machine. It doesn't just look for companies that pay a dividend, it looks for companies with the quality to keep paying and growing that dividend for decades. This guide explores the fund's rigorous quality filter, why it excludes famous names like Apple or Amazon, and how its 2026 performance is positioning it for a massive comeback as market valuations face increased scrutiny. 1. What is SCHD? The Quality Dividend Strategy. SCHD tracks the Dow Jones U.S. Dividend 100 Index. Unlike yield trap funds that blindly buy any company paying a massive dividend, SCHD uses a sophisticated 4-part screening process to ensure its holdings are elite. The SCHD filter system. To even be considered for the fund, a company must have a 10-year consecutive track record of paying dividends. Once a stock passes that hurdle, Schwab ranks it based on cash flow to total debt, can the company easily pay its bills, return on equity, ROE, is the management efficient at generating profit from shareholder money, dividend yield, how much cash is it paying out relative to its stock price, 5-year dividend growth rate, is the paycheck getting bigger every year? The result is a concentrated portfolio of 100 stocks that represent the blue-chip core of the American economy. 2. The 2026 portfolio, stability in a volatile world. In early 2026, SCHD's portfolio looks very different from a standard S&P 500 fund. It is heavily weighted towards sectors that provide essential services, the defensive pillars of society. Sector concentration. Financials and consumer staples. These often make up the largest slices of the pie. You'll find titans like Coca-Cola, KO, and PepsiCo, Pepsi, which have the pricing power to raise costs for consumers even during inflation. Healthcare and energy. Massive holdings in Merck, MERK, AbbVie, ABVV, and Chevron, CEVX, provide the fund with a mix of steady medical demand and high cash flow energy production. The no-tech reality. You will not find NVIDIA, Tesla, or Meta here. Because these companies either pay no dividend or have not paid one long enough, SCHD is almost entirely old economy. In 2026, this has become an advantage for investors worried about a potential tech bubble burst. Top holdings, January 2026. The fund is currently anchored by industrial and healthcare giants like Lockheed Martin, LMT, Home Depot, HD, and Bristol-Myers Squibb, BMY. Each of these companies is a cash cow, generating billions in free cash flow used to reward shareholders. 3. Financial profile. Low fees, high payouts. One of the reasons SCHD has over $75 billion in assets is its extreme cost efficiency. It is designed to let you keep almost every penny you earn. Key statistics. As of January 28, 2026. Expense ratio. 0.06%. This is industry leading. For every $10,000 invested, Schwab takes just $6 a year. Dividend yield. 3.6% to 3.8%. While growth funds like SCHG yield less than 1%, SCHD provides a significant quarterly check. In 2025, the fund paid out roughly $1.05 per share in total. Dividend growth. Historically, SCHD has increased its dividend payout by an average of 11% annually over the last decade. This compounding effect means that if you hold the fund for 10 years, your yield on cost could easily double. 4. SCHD versus VOO, the growth versus income tug-of-war. The most common question in 2026 is, why buy SCHD when the S&P 500, VOO, has returned more lately? The answer lies in risk-adjusted returns. The S&P 500, VOO, is driven by valuation expansion. It goes up because people are willing to pay more for tech earnings. If the PE ratios of tech stocks compress, VOO can drop 20% quickly. SCHD is driven by fundamental value. Its companies trade at much lower valuations, often 15 to 17 times earnings compared to the S&P's 25 times. In a market pullback, SCHD typically acts as a shock absorber. It may go down, but it usually falls less than the broader market because its dividends provide a floor for the stock price.
5. Critical risks. What to watch out for. Even a safe fund like SCHD has its weak points. Interest rate sensitivity. High dividend stocks are often viewed as bond proxies. In 2026, if the Federal Reserve keeps interest rates high, investors might prefer a risk-free 5% Treasury bond over a 3.8% SCHD dividend. This can keep SCHD's price stagnant. Sector lag. Because SCHD has almost zero exposure to AI and high-growth software, it will almost certainly underperform during bull runs where tech is leading the charge. If you only own SCHD, you might feel FOMO, fear of missing out, when the Nasdaq is up 30%. The value trap risk. While Schwab's filters are good, they aren't perfect. Sometimes a company has a high yield because its stock price is crashing due to a dying business model, either traditional cable TV or declining retail. The annual reconstitution in March helps clean these out, but you may hold losers for a few months before they are removed. 6. Investor strategy, the snowball effect. SCHD is the perfect candidate for a dividend reinvestment plan, DRIP. The strategy: instead of taking your quarterly dividends as cash, tell your broker to automatically reinvest them to buy more shares of SCHD. The result: in 2026, you might own 100 shares. By 2036, through reinvestment and the fund's internal dividend growth, you could own 180 shares, each paying out twice as much as they do today. This is how dividend millionaires are made, not by picking the next moonshot, but by accumulating high-quality cash flow over decades. Tax tip: because SCHD holds U.S. companies, its dividends are typically qualified dividends, which are taxed at a lower rate, 0, 15, or 20%, than the ordinary income you get from bond interest or REITs. This makes SCHD exceptionally tax-friendly for a standard brokerage account. Conclusion: the foundation of a resilient portfolio. The Schwab U.S. Dividend Equity ETF, SCHD, is not a get-rich-quick scheme. It is a get-rich-surely strategy. It represents the best of American corporate discipline, companies that have proven they can survive recessions, pandemics, and technological shifts, while still sending a check to their owners. The verdict: if you are looking for a low-cost, high-quality way to build passive income, SCHD is the premier choice. It is the sleep well at night fund that balances current income with long-term capital appreciation.